Imagine receiving your paycheck, and, for most people, the process feels almost automatic and predictable as money quickly begins to disappear into different directions. Bills are paid, subscriptions renew, shopping decisions happen almost instantly, and entertainment or lifestyle expenses follow without much planning. Whatever remains at the end of the month is usually what people try to save, but in many cases there is very little left. This cycle repeats itself month after month, year after year, creating a pattern of working, earning, spending, and repeating without any real financial progress taking place. This is where a simple but powerful principle changes the entire structure of personal finance. Pay yourself first. At first, it sounds almost too basic to have any real impact. Yet this idea has quietly helped millions of people build long-term financial stability and wealth over time. The concept is straightforward, but transformative. Because before paying anyone else or covering any lifestyle expense, a portion of your income is immediately directed toward your own future through savings or investments. It is not delayed, not optional, and not dependent on what is left over at the end of the month. The reason this approach works so effectively is that it completely changes financial priorities. Most people treat saving as something secondary, something that only happens if money is left after spending. Wealth builders reverse this mindset and treat saving as a mandatory obligation, just like rent or utility bills. The difference is that this particular bill is paid to your future self. By doing this consistently, financial discipline becomes part of the structure of life, rather than a temporary decision based on motivation or mood. Another powerful reason this system works is automation, because human behavior is heavily influenced by emotion, impulse, and convenience. Without structure, people often spend first and save later, but automation removes that emotional decision-making entirely. When a fixed amount of money is automatically transferred into savings or investments, the process happens regardless of temptation, excuses, or timing. This creates consistency without relying on willpower, which is often unreliable in the long run when financial choices are involved. Over time, this consistency naturally leads into one of the most important forces in finance: compounding. At first, the growth may appear extremely small, it's almost unnoticeable, but as contributions continue and returns begin generating their own returns, the system starts to accelerate. What begins as small, repetitive actions gradually transforms into meaningful financial growth over years. This is why time becomes one of the most valuable assets in wealth building, because the earlier the process begins, the more powerful compounding becomes in shaping long-term outcomes. Ultimately, the principle of paying yourself first works because it builds structure, discipline, and direction into financial life without requiring complex strategies or constant decision-making. It creates awareness, reduces wasteful spending, and ensures that wealth building happens automatically rather than accidentally. When combined with consistency and time, even small contributions can grow into significant financial security. The rule itself is simple, but its impact becomes powerful because simplicity applied consistently often produces the most extraordinary results over time.